By the end of this video, you're going to understand hard money inside and out, even if you've never heard of this term before. My name is Aiden, and I've closed hundreds of millions of dollars in hard money loans for real estate investors across the country. Here's what we're going to cover today. 1, what a hard money loan actually is and how it's different from a bank loan. 2, the real numbers behind rates, fees, and leverage. 3, what lenders actually need from you to approve a deal. And 4, the one question every investor should ask before signing anything: when does hard money make sense and when does it not? So let's get into it. What exactly is a hard money loan? A hard money loan is based on the property, the hard asset, not you personally. That's the core difference. When you go to a traditional bank, they want your W-2, your tax returns, 2 years of income history. They want proof that your personal income can support the loan and that the property itself has to be in move-in ready condition to even qualify. Hard money lenders work completely differently. We're not underwriting you as much as we're underwriting the deal. Is there enough value in this property for the numbers to make sense? That's the question that we're asking. That's why hard money is so powerful for fix and flip investors. You're buying a property that's distressed, that a bank would never touch, and you're going to add value to it. And a hard money lender will fund that vision in a way traditional banks simply won't. There is a trade-off though, right? Hard money is generally more expensive. Interest rates run from 8 to 12% compared to conventional loans who are sub 7. But here's the thing: hard money loans are interest only, which keeps your monthly payments manageable. And for transactional deals where you're in and out within a year and a half, the math still usually works out in your favor. Something to consider is that using hard money allows you to leverage your existing money to run multiple projects at once. So while hard money does cost more, oftentimes you end up making more profit in the long run from more deal flow. Let's talk numbers, because this is where most people get confused. The first term you need to know and understand is LTV, loan to value. This is simply how much your loan is as a percentage of the property's value. For newer investors, most hard money lenders will lend up to about 80% LTV. You might find at 90, but generally 80%. So on a $500,000 property, that's a $400,000 loan. As you build up your track record and experience, that can easily move up to higher 85, 90% LTV, meaning 450 on that same property. More leverage equals more borrowing. For newer investors, most hard money lenders end up lending about 80% LTV. So on a $500,000 property, that's a $400,000 loan. As you build your track record and experience, that can increase to 85, 90% LTV, meaning $450,000 on that same property. More leverage equals more buying power. Now let's talk about what the loan actually costs you every month. Say you have a $400,000 loan at 10% interest. That is 10% annualized, not monthly. So you take $400,000, multiply it by 0.1, and you get $40,000 for the year. Divide that by 12, and your monthly payment is about $3,333. That's it. Interest only, no principal. On top of the interest rate, there are 2 other fees that you really need to know about. First is the origination fee. This is typically going to be about 1 to 3% of the loan amount. It's paid up front as sort of a success fee to the lender for originating your loan. On a $400,000 loan at 2 points, that's $8,000. The second is the miscellaneous fees that actually come with the loan. There's the doc prep fees, processing fees, maybe a flood cert fee, and these are going to be usually $1,000 to $2,500, and it doesn't depend on the loan size. It's just the flat fees that the lender has part of processing a loan. So on a $400,000 loan, you're looking at about $8,000 in upfront points and maybe $2,500 in miscellaneous fees. Know these numbers going in and ask your lender about them so there's no surprises at the very end. One more thing on pricing: prepayment penalties. Some lenders do require you to hold the loan for a minimum of 3 to 4, maybe even 6 months, even if you sell the property faster. If you flip a property in 2 months but have a 4-month prepayment penalty, you'll owe an extra 2 months of interest at closing. Not every lender does this, and it's not as common. For example, we don't. But this is an important thing that you ask your lender before you sign anything, so again, you know what you're getting into. Now here's the number that really ties everything together: the ARV, or after repair value. That's what the property will be worth after you finish the work, the renovation. Every hard money lender is going to look at your total loan amount, your purchase loan plus your rehab loan, and make sure it stays below their ARV threshold, which is generally 75%. So why is this? The reason is because that gap is your profit margin. If your total loan is already at 90% of ARV, there's no room for you to make money, and there's no cushion for the lender if something goes sideways. That 70% cap protects both of you and the lender. This is also why knowing your ARV before you call a lender is so important. It tells you immediately whether you're working with a deal worth pursuing. If the numbers don't fit inside that box, the deal really doesn't work, and no lender should be funding it. And if you've got a deal you're looking at right now and you want to run the numbers with someone who's closed hundreds of millions in deals, that's exactly what we do at RSC every single day. We'll tell you straight up whether the deal works, what you qualify for, and what you need to bring to the closing table. Click the link below and we'd be happy to help you out. So let's talk about what actually goes into a hard money loan application, because that part typically trips people up. Here's what most lenders are going to be asking for. 1, your ID. We need some form of verification to understand who you are. And because you're going to be buying these through entities, these are business purpose loans, we're going to ask for your LLC documents or your corporate documents, your articles of incorporation, operating agreement, or corporate bylaws, and an EIN number. The next is going to be your liquidity statements, right? Bank statements or brokerage accounts showing you have enough funds to close. That means for your down payment, closing costs, a portion of your rehab budget so we know you can start it out of pocket, and a few months of reserves for the interest, just so we know that you have enough money to close, carry some of those closing costs, and not end up on the street. For the property itself, you'll need a fully executed purchase agreement signed by both parties, buyers and sellers, along with all the applicable addendums. You'll also need your contacts for the deal as far as your title, your escrow, and your insurance agent. The next thing that you'll need is an appraisal, and this is either ordered directly through us from an appraiser on our panel or through an AMC, appraisal management company. One more thing, loan minimums. Most hard money lenders have a minimum loan amount, typically around $150,000, although some are lower and some may be higher, which usually means a purchase price of $200,000 or more. Below that, true private money, such as using a friend, family member, or local hard money group, might be a better fit than an institutional lender. This is the most important question, and most investors never ask it, and it is, when does hard money make more sense over traditional financing? So here's when hard money makes sense. You need to move fast on a deal and can't wait 30 days for a conventional lender. The property needs work that a bank just generally won't finance. The deal has strong profit potential that justifies the higher cost of the loan. Hard money also works when a project is categorized as uninhabitable, as traditional banks will not finance it. So here's when it doesn't make sense to use hard money. You're planning to hold the property long term with no real major renovations. Use a conventional loan. The rates are cheaper and you avoid paying closing costs twice. You're buying a primary residence. Hard money is for business purposes only, full stop. And if using hard money means putting every dollar you have into one deal with nothing left in reserves, that's too much risk. The interest rate is too high to be stuck in a bad position in a loan. Hard money is a tool. Like any tool, it works great in the right situations and costs when you use it in the wrong one. Investors who do this successfully long term know the difference. So to recap, hard money lends on the deal, not just you. Your rate is interest only, typically between that 9 to 12% range. Your fees are going to be those origination points plus those miscellaneous processing fees. Your total loan has to stay within 75% of ARV, and you need to come to the table with your down payment plus your closing costs, while still ensuring you have enough money and liquidity for your reserves and to start off your renovation. Know these numbers before you call a lender, and you'll walk into every conversation with confidence. If you're ready to talk through a deal or just want to know what you qualify for, click the link below. I'm Aiden, and I'll see you in the next one.